Good morning, folks. This has been a week of nail-biting suspense for countries around the world. All news has been completely dominated and hijacked by what the US President Trump would be doing as far as tariffs are concerned. But before we get into that, we should not ignore the other news items that are there and are worthy of mention. So we'll quickly look at these news headlines before moving on to what the tariffs have done. Okay? So the Mint on Tuesday had an interesting article. The headline says, "No impact of FII selling on Indian stock market." Okay, so this was a comment made by Sanjay Bhattacharya, who's managing partner of Fortuna Capital, and at a Mint conclave. It was a Mint India Investment Summit and Awards in 2025 in Mumbai, where Sanjay Bhattacharya and Devina Mehra of First Global were discussing this issue. Sanjay, as some of you may or may not know, is a top fund manager who was CIO at HDFC Mutual Fund before deciding to call it quits and running a small privately managed equity investment. So here, let me read out. A typical theme that has dominated equity market conversations over the past 6 months is whether the domestic institutional investors should keep funding the relentless exodus of foreign institutional investors from the Indian stock markets, because we have seen almost 2 lakh crores of stocks being sold by FIIs in the last few months and hardly any buying that has taken place by them. And as you know, in the stock market, it takes 2 hands to clap. So if somebody is selling, somebody's got to be buying. So if the FIIs are selling, it's obviously the domestic institutional investors are buying. And if the FIIs are booking profit and going away, we have been buying the stocks that they are selling. And that is the debate, whether we should be providing this exit to FIIs at all. So investors should look beyond the us versus them mindset, as falling markets usually have barely any correlation with FII selling. Please don't. It is a fool's errand to second guess what FIIs are going to do, as there is no correlation between FII selling and markets falling except for the latest one, said Devina Mehra. Okay. Between 1994 and 2003, FIIs were invested in India even when the net return on the broader index was 0%. So just because the market is falling or no return, FIIs don't exit. There are various other reasons. Let's see what they say. Okay. Market participants should not attach any sort of morality to the FII's current rush for the exit and not see them as fleeing the domestic market, says Sanjay Bhattacharya. Okay. The overvaluation of Indian equities relative to its peers and a tepid corporate earnings growth trajectory led to the latest exit of FIIs from the Indian market. Okay, very important to note. While encouraging increased bets on domestic equities, the experts also said that portfolio diversification is increasingly becoming more essential now than ever. Diversification is the only free lunch in the industry, which gives you that extra protective cover against market volatility, said Bhattacharya. So let's remember that point very, very carefully. Diversification. Of course, he also goes on to say that over diversification should be completely avoided, because that could eat away whatever alpha that is otherwise possible to have. Okay. The one thing about diversification is that anything good in life can be taken to excess. And when you own such a large number of stocks, you lose some of the benefits of diversification, because there are what are called cancelling out effects in portfolios, says Bhattacharya. Okay, let's keep that in mind. Then the Thursday paper had a headline about one of the largest Indian companies, RIL earnings growth to rise in FY26 as per Goldman Sachs report. Brokerage continues to see favorable risk reward for the stock. Okay. RIL has been a very tepid performer the last year. Earnings growth has not been very good, and investors have accordingly not given much attention to the stock. So Goldman Sachs believes that earnings growth will resume in FY26, driven by a rebound in retail earnings, before interest, taxes and depreciation and amortization growth. Acceleration in Jio's earnings growth to 24% and improving refining margins. So they're saying that retail will do better, Jio will do better, and the traditional oil business will have a better refining margin. So all these three would contribute to RIL having a better earnings growth this year. Okay, so one of the things that pulled down RIL last year was the weak performance of the retail segment of RIL. And they had to go in for a lot of restructuring and shut down hundreds of stores, retail stores. And now I think they may be coming down to a better mix at the end of the day. So now let's come down to today's paper, Friday's paper, and it's all about the tariffs. So we had a landmark press conference by the US President Donald Trump yesterday early morning India time, where he announced the tariffs on all the countries. So it was an unprecedented measure where tariffs were announced at one single shot over 185 countries. And almost the last few weeks, investors around the world have been waiting in suspense to see what would happen. While the consensus was that it would not be good, they were still not prepared for the scale and extensiveness of the tariffs. Okay, what caught investors and the markets by surprise was the logic that was used by the Trump administration to levy these tariffs. On the face of it, it did not have any logic, but there was a formula used by the US government to apply these tariffs, and it was a ratio of the exports to the trade balance between any two countries. And that's why it was not exactly related to tariffs, because these numbers are way out of sync with any kind of tariffs that are imposed by the other countries to imports from the US. Okay, a lot of Asia Pacific countries bore the brunt of the tariffs, the highest tariffs by small countries like Cambodia and Vietnam and Myanmar. So Cambodia has a 49% tariff, Vietnam a 46% tariff, and Myanmar 44%, followed by Thailand at 37%, China at 34% in this round. There were already 20% existing tariffs. So overall, there's a 54% tariff on China. Okay, and India got away relatively lighter with a 27% tariff being announced on Indian goods as compared to its neighbors and some of the other countries. Countries that got away light were Mexico and Canada. Okay, while the initial fury of the Trump government was on these two countries, in the final tariffs that were announced, Mexico and Canada got away lightly. So it does seem that instead of offshoring, the concept of nearshoring will take precedence, and actually there may be more outsourcing of manufacturing to countries like Mexico and Canada to some extent. Okay, energy has been left out of the tariffs. So any imports of energy into US will not have any tariffs imposed on it. Other sensitive sectors like semiconductors and pharmaceuticals have been left out of this ambit. Okay, so India has a lot of pharmaceutical exports, and there's no impact of tariffs on these pharmaceutical exports, as we shall see. Markets obviously reacted horribly, and while the evening when Trump did announce, the US markets were even slightly positive, thinking that it would not be a massive impact. But as the press conference went on, it became the scale and viciousness of the tariffs became evident, and that entire impact was absorbed by the market yesterday. So as a result, as of yesterday night, the Nasdaq Composite fell by 5.3%, the S&P 500 fell by 4.1%, and European markets also fell between 2.9 to 3.5%. Then Nikkei fell by 2.8%. The Hang Seng fell by 1.5%. By the way, the Nikkei and the Hang Seng had fallen much more The previous day, the previous week, all these markets had fallen much more. But the US and European markets showed their disappointment in yesterday's trading. The Indian markets did not do as bad. Yesterday, the Sensex fell only minus 0.4%. Okay, largely because it felt that we got off more lightly. Okay. Amongst the Indians' indices, the textiles and apparels index went up by 3.1, pharma went up by 2.1%, whereas IT went down by 3.9 and auto went down by 1.1. Seafood and meat products went down by 6.2%, and the chemicals index only by 0.4 as per the report on the front page of Business Standard today. Okay. Going in, before we go do a deeper dive into the tariffs, we see that two-wheelers had a pretty good ride in FY25 and sales grew by 7.3% in the Indian two-wheeler market. Okay. There's a chart here. Most manufacturers record double-digit growth in March. Okay, but let's look at the entire year's performance, the year-on-year change. The best growth was by Suzuki at 14%, followed by TVS at a 12% growth, and then Royal Enfield with an 8% growth. The other two large sellers, which are Hero MotoCorp and Bajaj Auto, recorded a much lower growth. Hero at 5.51% and Bajaj at only 3%. Okay, in terms of the volume of sales, it does seem that the largest is Hero Moto at 5.47 million, then followed by Honda at 5.3, and then you had TVS at 4.33 million two-wheelers sold in FY25, and then Bajaj Auto at 2.3 million. You have Royal Enfield at just a 902,000 and Suzuki at about 1 million sales in the FY25. Okay. Some of them have better exports, components of exports, but the talk by analysts is that given that almost 2 crore two-wheelers are being put on the streets, henceforth the growth may not be as good as we have been seeing over the last few years. And what the analyst says, considering the sheer volume of two-wheelers already on Indian roads, with projections nearing 20 million units annually, it's difficult to sustain the current high growth rates. My assessment, based on current economic trends, suggests a more realistic single-digit growth of around 5% over the next 3 to 5 years, says Anurag Singh of Primus Partners. Okay, so there we have the two-wheelers, and okay, then going deeper down into what's going to be the impact of tariffs. The newspapers are filled with reports on what different experts think, and I find a fair amount of contradiction as to what experts think about the impact on different sectors. So I think that while we can read, but the true impact will be evident only after industries are able to absorb the information, the fine print, and see what's happening on negotiations. So it will be a few months before we know the true impact of any of these tariffs. But all the same, let us see what is going to happen. Exporters flagged concerns of dumping from China. We spoke about this last week also. One of the edits were cautioning us about this, and that continues. Okay, industries are worried about dumping from China. Okay. There's a chart here as to what India exports to the US and how the tariffs could be impacting is what we have to derive from it. The top 5 merchandise exports to the US in 23-24. Engineering goods were 17.6 billion. Electronic goods were 10.1 billion, gems and jewelry at 9.9 billion, textiles at 9.2 billion, and pharmaceuticals at 8.7 billion. So total exports to the US from India is only about $77.5 billion. That's not a very big deal. And the eventual trade deficit is only about $30 to $35 billion on merchandise. The big thing that is not being talked about is the services exports. Okay, while merchandise exports is 77.5 billion, services exports this year to the US alone from India will almost be about $325 to $350 billion. So that is the big one. And the tariffs do not speak of services. It is only on goods. So whatever services, US is a large exporter of services. So I guess that is one reason why they have kept services out of the entire ambit. They would not want to impact their services exports. And for India, services is a larger export. So we are also good on that. Electronics goods at $10.1 billion would also include $5 billion of mobile phone exports. Okay, almost half of it is mobile phones. And to the US, the tariffs on this is going to be worrisome. It is left to be seen how Apple, which is the largest assembler of phones in India and exports most of this $5 billion to the US, how they are going to react to this. Where is the cost going to get absorbed, and who's going to be paying for the tariffs? Is it the US consumer, or is it the exporter or the manufacturer? There are a lot of moving wheels there, and we still don't know what's going to actually happen. It all depends on the elasticity of the consumer. If the consumer is able to pay more, the cost will be passed on to the consumer. If the manufacturer is having a high margin and is able to absorb it, the manufacturer would be absorbing the tariff. So let's see what happens eventually. Okay. Again, it does seem that since India has been imposed a lower rate of tariffs than its competitors around us like China, Vietnam, Thailand, Philippines, we may have an edge. We may be more competitive than these countries only because of the lower tariff being imposed on Indian exports to the US. There is some optimism on this, especially textiles. Where much of it would go from Bangladesh. It is possible that if India can ramp up its manufacturing, some of these could come to India only because it is cheaper than to export from India than from Bangladesh. All this is pre-negotiation. Once each country negotiates with the US independently, we do not know what will be the end result. Okay, so there's also an interesting development. In some cases, countries may be independently negotiating with the US. Otherwise, they're coming together in blocks and together negotiating with the US. So there's going to be a whole lot of realignment happening, and this trade obviously is being disrupted. Okay, we are going to have a lot of multilateralism, and it is no longer going to be a unipolar world that we see going forward, whether in terms of military strength, political power, or trade power. So I think the last couple of decades were very, very different from what we are going to be seeing in the next decade at least. Things like this can easily get disrupted, but takes a lot of time to set right again. Okay. The other headline says India Inc. weighs options. So what the large industry groups in India are now going to be focusing more on investing for the domestic market, where they can be sure that there are no disruptions. So the Aditya Birla Group is been looking at investing about $2.5 billion for expansion of Novelis in the US. Okay, and the Adani Group was planning on $10 billion in energy security and infrastructure projects in the US, and JSW Steel committed $110 million to expand steel operations in Texas. So this is what they had already committed, and it will probably stand them in good stead if they're able to do this. Okay, and post tariffs, India Inc. leaders say they are turning their attention inward, seeking fresh investment opportunities in domestic markets. Okay, so let's see what happens in this. Automakers are going to face some flack, not clear how much yet. So let us see how that pans out. Okay, then an article by Madan Sabnavis, Trump tariff impact, brace for exchange rate wars too. So we have to be looking out for a lot of activity in exchange rates across the world. Okay, it says 3 things need to be kept in mind when analyzing the impact of the new tariff order imposed by the US. The first is whether higher tariffs will lead to more domestic production in the US. If the price factor kept local production down, then this will help. But the consequence will be higher inflation for sure in the US. and conversely, deflation in the rest of the world because of dumping. Second, the relative tariffs now imposed across countries matter. Hence, India has to look at competition from countries which attract lower tariff rates in the new regime. The third is whether the relatively smaller countries can scale up to substitute for others. This begs the question as to whether countries have the ability to scale up substantially to substitute other exporters. That also applies to India, if you ask me. Do we have the ability to scale up manufacturing and take advantage of all this? Okay. We would also probably see a lot of attempts to depreciate currencies so that it can offset the imposition of tariffs. So you see, the country's exports have to become competitive in spite of tariffs. How can they do that? Depreciate currency. Okay, so there's going to be a whole round of depreciation everywhere. We have no idea who will be the winner, because as of now the dollar is also falling versus the G7 countries, not the EMs. The global stock rout deepens, and you have companies like Apple stock falling 8.3% yesterday, my friends. Amazon fell 7.5%, Nvidia fell 6.8% in one single day, Meta Platforms by 6.4%, Microsoft by 2.1%, and Berkshire Hathaway, it is not mentioned here, but Berkshire Hathaway hardly fell 1%. Berkshire Hathaway has been holding cash of more than $300 billion over the last few months because, as Warren Buffett says, there were no opportunities for him to be buying into. So I guess the opportunities would be coming up now with this kind of a fall, and Berkshire Hathaway is sitting on so much cash. Okay. So the other headline says, domestic sector's safer bet amid tariff risk. Okay. So exports obviously could be rendered uncompetitive because of tariffs, and hence, till that is clear, those selling to the Indian markets are going to be safer off. So the BankX actually went up, okay, yesterday, and even year to date the BankX performed 2.5%, whereas all other industry sectors were negative. Consumer durables year to date is minus 15%, whereas the one day is 0.5%. BSE Healthcare was down 7.5% year to date, whereas in the yesterday it was up 1.8%. So because this was the impact of pharma being left out, so healthcare stocks went up, and so the defensive sectors are banking, consumer durables, healthcare, FMCG, consumer discretionary, and telecommunication, as per the BS Research Bureau. Okay, and if you want to be shielding yourself from exports and looking at domestic markets, then these would be the segments that you would want to be looking at, is what the article says. Then again, the next article says, under your money, lower drawdown during market fall boosts long-term return. So how do you get lower drawdown? Okay, you can get lower drawdown by going into factor-based exchange traded funds like the low volatility index. Okay, the low volatility index typically consists of the least volatile stocks within a particular index. For example, the Nifty 100 Low Volatility 30 Index includes the 30 least volatile stocks within the top 100 companies, okay, by market cap. Low volatility funds use simple rules to pick companies that tend to be more stable. They can help smooth out returns during market ups and downs, says Pratik Oswal, head of passive funds at Motilal Oswal AMC. Okay, so but on the other side, while it can help you contain drawdown, in a bull market you're not going to see these returns running away either. Okay, so those are the testing times when the investor should be holding on to the funds, knowing that in a bad time you're going to be needing low vol. Okay, so it is best to hold on and make it part of your asset allocation. But as he also says, concentration risk is another issue. As these funds prioritize companies with lower price volatility, they can become concentrated in specific sectors, typically defensive ones, reducing diversification. This sectoral concentration can expose the fund to greater losses if those industries face problems. Okay, so that is why again diversification is important. Your entire portfolio cannot consist only of a low vol fund. You need to be having all styles in your portfolio to weather the storm. So that brings me to the end of a nail-biting week. Let's see how the rest of the week pans out, how the next week pans out. Till next Friday, have a good weekend. Thank you.